Now, that money, I believe, has not yet come in, right? So this suggests that there could be a big bolus of money, maybe over the next 2-3 months coming in, which would, of course, prompt the rupee higher. Which now, since investors, speculators, they try to judge the market, what's going to happen. So conceivably, people may have been buying rupees in anticipation of these inflows which are yet to come in. And the other big play, of course, is the portfolio flows. Now, in fact, if we go back, towards, let's say, last year, when things were really falling apart long before the coronavirus, the rupee was holding up pretty well till it took a hit, 6 months ago. And it was always a surprise, but the reason was clearly because globally interest rates were so low that people were looking for places to take risk where they could make a little better return, and money was flowing into India, right? The reserve kept rising sharply till, of course, this coronavirus crisis hit. And the rupee tumbled, B, money started pouring out of, portfolio money started pouring out of India. Curiously, during this period, our reserves went up. And I'm still a little confused about that. I mean, RBI was actually buying dollars to prevent the rupee from appreciating more, right? So it's how, conceivably at that period, it was the current account, the sort of the decline in the trade deficit that was pumping up the that doesn't make sense. I still don't understand why, while money was pouring out of our equity markets and debt markets, much more out of the debt market, by the way, than the equity markets, why the RBI had to keep buying dollars to prevent the rupee from strengthening. But that is the reality. That's what this will show. But here is the real market. As I mentioned at the beginning, over the last week, things have changed direction twice. Well, if we go back over the last 2 months, they've changed direction 3 times. First was when the crisis hit financial markets, and portfolio money was just pouring out like there was no tomorrow. Rupee came crashing down, went to 76, 78, or whatever level that was. So it took a breather and bounced back. And little by little, global markets, because the Fed and the ECB, but primarily the Fed, really decided to open the gates and allow really free money. So globally, investors just started looking for, well, equity markets globally went up, and then they were looking for other places to take risk, and money started pouring into our markets. In fact, I've been, I study different things because what else is there to do, right? And one of the things I've noticed over the last couple of years is there is a pretty strong correlation between the Dow and portfolio flows into India. The correlation was around 50-55%, which is a strong positive correlation, which broadly means if the Dow is going up, money is coming into India. Also makes sense, they're all risk assets, right? Well, what happened in the last 2 weeks, right, since the rupee started recovering and the equity markets have started recovering, that correlation has gone up to 89-90%, which would suggest that right at this minute, the impact of what happens on the Dow should be felt immediately and completely on the Indian market, right? So I guess we really need to focus on the Indian market, but not just the equity market, but the rupee as well. So we need to focus not just on what's happening locally, which really seems to be taking a backseat today in terms of looking at the future of the rupee, and look at what is going to happen to the Dow. Now, as we know, while the Dow recovered, I mean, amazingly, a lot of analysts, myself included, feel that these levels are crazy. I mean, there is no way you can sustain these price equity ratios. I mean, the market has to come down. And sure enough, the market just kept going up and up and up. I mean, the NASDAQ actually hit an all-time high, right? And then suddenly, 2 or 3 days ago, the market collapsed. Why? Well, it could be that the US was reopening and people were worried that the corona, you could look for any reasons, but there is no reason that, there is no real way to predict A, what will happen. No, let me step back. A, there's hundreds of variables, and it is really impossible to predict all of them, but most of them. And more importantly, even if you are able to perfectly predict them, you really don't know how the market will respond, which is one of the reasons why 25 years ago or so, I learned 20 years ago that forget trying to forecast markets, you'll never succeed. You need to figure out a way to deal with it. But let me come back, I'll go to there later. Let me come back to the situation right now, which is again confounding, because yesterday the Dow fell sharply, right? And our market today fell sharply. Importantly, the rupee crashed, right? And opened today above 76 for the first time, I think, in 45 days, weaker than 76. But by the close of play, it was again below 76. I'm pretty certain it must have been RBI pushing it down. But so what's going on? What is going to happen? There's another detail, but another area of evidence that I think we need to look at. This is rather important, which is the NDF market. The spread between the NDF and the domestic market. Over the last 10, 15 years, the NDF was a baby 15 years ago, but it has grown and grown and grown to where the NDF market, the non-deliverable forwards market, is larger than the domestic dollar rupee market. In fact, RBI has been very concerned about it. They had a committee run by Usha Thorat to look at it, what should they do, etc. And sure enough, they've come up with, I frankly didn't think they could do much, but they have come up with some things which are significant. And for the first time, I think sometime in April, RBI actually intervened directly. I think it was through the PIS or something in the NDF market. They bought $500 million, right? And that really shook up the market, and everybody then became, no speculation for a while. Well, what I'm finding, and this is something you live and learn every day, I monitor this. I monitor the spread between the 1 month forward and the NDF and the 1 month forward onshore. But foolishly, I've just discovered, foolishly, I monitor it while I'm in the office, right? Now, that means both markets are open. So the spreads never move very widely, right? Because it would get immediately arbitraged out. The time you begin to see what the NDF is really doing, which tells you what global investors think, is after the closing of Indian domestic market hours and while the NDF, which is a 24-hour market, continues, right? And to my amazement, what I saw was yesterday, the NDF was 42 paisa out of 1 month, 42 paisa, the dollar was 42 paisa stronger than the onshore. Clearly people thought the rupee was going to help. And sure enough, it opened today at 76.10. RBI has pushed it back and full marks to them for that. But I'm saying that whether now will they be able to continue to hold the NDF off, and markets are ultimately, speculators are actually cowards, right? If the pressure gets too hot, they leave. So if RBI can hold the line, chances are things will quieten down now. Today, for example, it closed 2 paisa, from 42 paisa weaker to 2 paisa weaker. It's a huge move, right? So, and one of the other things that RBI has done, and really I must say I was wrong about that committee. Usha is a good friend of mine, and I talked to her a few times, because they've also now opened up the GIFT in Ahmedabad, where domestic banks, or any banks over there, including SBI, etc., can directly access the overseas market. Now, what that means is you, as a corporate, if your banker is in, you can access the NDF market. You can access arbitrage products between the NDF and the domestic market. You could access all sorts of structured products for which there's no liquidity onshore. So these are positives, from a market standpoint. But my belief is I don't think companies, corporates, really should be focusing on complex instruments. I mean, in general, unless you're someone like Reliance, who is actually got is trading. They're not the only ones. There are a few, maybe 15 or 20 companies in India who actually run FX trading. I don't think you guys should be looking at that, right? So what should you be doing? And I mean, before we go there, let me just sort of summarize what I've been talking for about 15 minutes. And basically, the summary of everything I've said is, baby, I don't know what's going to happen. I mean, the fundamentals, if you will, economy is bad. No one knows how this virus is going to work out. Businesses are having difficulty coming back. Global supply chains are dead in the water. I mean, there is really nothing to really commend investing in India, So really, from fundamentals, the rupee should be down, 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 down. I have a very good friend, brilliant guy, who has been saying the rupee would be 85. He was saying 80 for a long, long time. And then once it crossed 75, he got excited, and then he was saying 85. He's licking his wounds right now because the rupee is, who knows what's going to happen. So on the one hand, you have views like that. On the other hand, you have views like some banks who are saying, well, 74, which is not very far from today. But, if Mr. Ambani's money comes in and the risk on mode in the US continues, I mean, the rupee could remain at this level or even get stronger. So the truth is, I don't know. And frankly, nobody knows, right? So what do you do? Okay. Well, the simplest way to address the fact that you are exposed to a currency market, I mean, you should keep things simple, right? Now, the simplest solution is to hedge everything on day one. Very few companies do that with good reason, because A, you're never certain, particularly in this day and age, what your exposures are going to be. And I don't know why. Very few people on the export side, at least, sell everything. Some importers do buy everything. But I'll come to a separate point on that. And in fact, let me step back for a minute from what we should do and talk briefly about what I feel are the three key principles of risk management, right? The first one is actually, how do you identify risk? You should, and I believe you need to identify risk to the longest meaningful tenor, right? And what does that mean? It really depends on your business. If you're in the IT business, for instance, IT companies have long-standing contracts. For a minute, let's forget about the current trauma, but let's talk generically. So, IT companies could hedge out to 2 years with no trouble, perhaps even longer. And just a little bit of history here, going back 20, 25 years, I've been in this trade forever. There were a very small number of really professional companies in India that I knew of. And there, most people would look at, well, my business plan is 12 months. I will identify risk to 12 months. And in fact, what some companies did, they only identified risk for the financial year, April to March. It then got a little more sophisticated and moved to a rolling 12 months. Then in 2006-07, when the rupee for the first time started strengthening, a lot of people felt that, hey, let me see if I can go longer. I've got exposures. And the longer I go, the more premium I can get. And they went from 12 months to 24 months. Some companies went as far as 5 years, right? Now, to my mind, that's fundamentally wrong, because they went out to 5 years because they had a view, right? Which is that maybe the rupee will remain strong, and I need to protect myself by earning some premium. And I'm saying a view has no place in this, in fundamental decision making. I'm saying that basically, like I said, if you're in the IT business, you can look at 24 months. You can look at longer, but there is much less liquidity for hedging out there. So what you gain, you would lose on the other side. If you're in sort of the manufacturing business, now most companies who've been around a while, they've got long-standing relationships. While they may not have orders in hand, they are reasonably sure of how much their customers are going to buy, with the world not falling apart. So you could look out to 12 months quite easily. And I think that's a good tenor for most exporters. For importers, few importers look out to 12 months. Importers say, no, Babu, I will only hedge when I have my actual purchase order in hand. And normally 60 days, 90 days, 120 days, that's all I will hedge. Well, then you could make a case for that. Why not there is a lack to them? Because the reality is you are a going concern, right? I mean, if you have been, the truth is today we're in June 2020, you have got risk in June 2021, 2022. So I would say importers should also think in terms of extending their tenor of risk identification. Maybe if you're doing 3-4 months, maybe you could look at 6 months. You don't have to jump to 12 or 24 months right away. But if you really want to look at the risk on your company, you really need to recognize that you have risk forever. Okay, so that's the first principle of risk management, is to really identify your risk correctly, right? And this is something that we as advisors can only assist. I mean, you know your business much better than I am, right? The second principle of risk management is that you should carry as little risk to market as possible. You don't want to be in the market, right? So what that means in practical terms is that any natural hedge you have, you need to utilize it to the maximum extent you can. And many companies do this, but I think you need to do it in a very structured way. There's ways in which you can actually make money managing the natural hedge. We can talk, separately on that. That's not too detailed for this discussion. So managing the natural hedge is also very, very important. Sometimes there are tricks there. You may have imports in euro and exports in dollars, or the other way around. You've got to figure that out. But I mean, conceptually, you need to ensure that as much of the natural hedge, that you use as much of the natural hedge as you can, right? And the third key principle, in my view, and there's not too many people who agree with me on that, is that, look, do not use a market fee, period. I'm sure many of you have been in the market long enough, perhaps not as long as me, but long enough. And, it's hard not to say, oh, but this will happen, that will happen, etc., etc., etc. But over time, you will always lose. And a sort of subset of that is to always have a risk limit or a stop loss. Let me just come back for a minute to the simplest ways of managing risk, and then I'll talk a little more about what I think you should do. So as I said, A, we don't know what's happening. Oh no, let me take that back. A, we have an exposure. B, we don't know what's happening. We have to acknowledge that. It's very important. All right, so you can hedge everything on day one, as I said. You can hedge nothing, which you should never do, whoever you are, whatever your business. Or really what is reasonably sensible there is you hedge 50%, right? I mean, I always tell clients when I'm talking in the office, the guy who brought the tea, just ask him what you should do. And he says, Saab, aadha kar do na. When you don't know what's happening, flip a coin. So a 50% hedge is really not a bad approach. It's very simple to implement. And it reflects the reality of markets, right? But it does have one drawback, right? Which is, let's say you've hedged 50% and the market moves 15% against you. So your exposure will be 7.5% off the money. And the limitation that a 50% hedge has is that it doesn't have a stop loss. That's what I was starting to say. The processes we have developed, the first step is you have a stop loss. Now, okay, where do you set the stop loss? These are technical issues, they're not very complicated. What is difficult, and very, very, very difficult, is to respect the stop loss, right? I mean, the number of clients we've had who've set the market comes down, the stop loss is hit. And the natural thing is, array, suppose I cover today and the market turns in my favor tomorrow. True, and it does sometimes. But I am saying, just trying to constantly play that game, you'll lose more hair than I've lost, and you're just not going to get anywhere, So the processes we've developed all have a stop loss, which is key. And then we create certain rules, right? So we have two models, one for exports and one for imports. For exporters, I sometimes describe it that it's like an SIP, but it isn't really. Basically, you have a stop loss on day one. You cover some part immediately. You cash the full premium for 30, 40% or whatever. And whenever the market moves by a preset amount in your favor, you hedge some more. Now, if you think about it, that's really what people tend to do anyway. But what happens is if you leave it to your discretion, let us say the market has moved by 60 paisa, let us say yesterday, the rupee moved from 75.50 to 76.10, right? Now, you say, well, I got 50 paisa, maybe it'll go to 76.25 tomorrow, right? So you can't leave it to your heart, your judgment. Because one of the other things is very funny, and it's the truth. If you are an exporter, you will keep, and there's lots of information in the world, you will absorb more closely information that makes you better off. In other words, you will be inclined to look for everything that will make the rupee collapse. And on the other side, if you're an importer, you'll think about Mr. Ambani's money, you'll think about the inflows, you'll think about this, you'll think about that. I have clients call me and told me that, and I laugh because it's so transparent. It's human nature, You want things to go in your favor. So you will select out of the billions of things going on in the world, you will select things that favor you. Well, the world doesn't work that way, So, we need to find a way, and that's the trickiest part of my business, is trying to convince companies to not look at the market, because the market will kill you every time. So, as I said, so on the export side, it's straightforward. You set a stop loss, you set something, you keep hedging. It goes against you, you exit. And this is key. We can make it softer. We've got some tunings where you don't hedge everything. But the goal, let's remember, what is the goal, right? There are two goals. The goal is to protect the stop loss. Like whatever happens to the market, your export should not achieve less than X amount, right? And the second thing is, of course, you want to make some money, right? If you can. And it's a good thing to make money. Nothing wrong with that. I'm all for it. So what our model does, and that's what I'm really proud of, over the last, God knows how long, but I've got the numbers over the last 5 years, it has beaten a 50% hedge. Now, remember we said 50% hedge is conceptually sound. It has beaten a 50% hedge. This is for dollars, I think 0.78% or something like that. Now, you could say, what's 0.78%? Well, sorry, baby. But I think that's another sort of precondition. You need to understand, need to set reasonable targets in the market. And if you can, make 0.7%, 0.8%, on $10 million, it's money, right? It's about 80 lakhs of rupees. On $100 million, it's 7-8 crores of rupees, right? So I would say that, we need to be reasonable in our expectations and very disciplined in our operation, right? In fact, one other thing I'd like to say about our export model, which is important at a time like this, the model is very conservative, right? It keeps hedging every time you get a little bit you put in your pocket. So as a result, let's say you've got a 12-month exposure, in about 3 months, you're usually about 70, 80, sometimes 85%. So if the market tanks, as it has right now, and as it did 2 years ago, all those exposures are out of the money. You've missed opportunity. You have an MTM loss, but that can be managed by hedge accounting. And that is something I would also recommend we all get deeply involved with, right? So the fact is, but it hurts also. Damn it, I covered it 72.80 and it's 77 now, or 76 now, or whatever. Well, the truth is that does happen. No system is perfect. You can't beat the market. But over a period of time, over the same 5-year period, where I said that, we beat a 50% hedge by 0.78%, we beat a zero hedge, which would be like spot on the last day, I think 1.5, 1.6%. Now that's real money, right? And this includes the period where we lost money. So I'm saying that the model delivers value. I mean, the real goal is to beat a 50% hedge. What it happens against day one or against zero hedge, another story. I'm saying 50% hedge is sensible. If you can consistently beat a 50% hedge, you've done very well, right? That's for the export side. For the import side, it's a little trickier. The model is we've played with many models, and we've got one now that we're reasonably happy with. They're sort of the target. It is we want to be at a 50% hedge, but we have set another way of looking at it, because a lot of importers, is ultimately about financing cost, right? So our model for these are companies who've got short exposure, let's say 90, 100, 120 days. The client has been using it since September 17, and all the way up to October 17, all the way up to MTM of September 18, September 21, September 20 exposures. They have saved 1.9% per annum in terms of financing cost. And to my mind, that's real money. They've also been a 50% hedge, So I feel that, again, same story, stop loss, which you have to, respect. And it's different. We don't keep hedging. See, in the export side, you keep hedging because you want to keep collecting premium. But here, you really hedge as little as possible unless the market goes again, right? There are difficulties. No model is perfect. The difficulties here are, while on average, this company saved, 1.9% per annum, the results are volatile, right? And some companies cannot manage that, cannot afford that. Sometimes they paid 3% more than day one. Sometimes they made 6% better than day one, So that's the story. Frankly, at some level, I've been saying this so long, all of you have probably already heard it. But that's what I wanted to say. Recognize that the market is, the monsoon is coming like the monsoon sea. Don't go swimming. So that's the sum of what I wanted to say. I don't know if there have been any questions. We'd be really happy to take them.
Thank you so much, Jamal. So we can have the questions. I don't have anything in the questions tab other than one. That is about elaboration on the point made between the relationship between the NDF and the onshore market. So that is one question that has come in.
Okay.
So, that's the only thing. Maybe we can send a note also to talk on that. Or if you have something more on that, you can go ahead. That's the only question for now.
Well, let me address that. The NDF, I guess you all know it's a non-deliverable forward market. It's been around for decades. I remember, we have a business, a sister concern in Sri Lanka, where you can do offshore work. We were doing offshore deposits for Indian banks and this and that. So I was dealing with people in NDF market a long time ago. And in those days, I remember, it was amazing. The total market volume was things like $15 million a week, right? Today, I think it must be something like $30 or $40 billion a day, right? The domestic market the onshore market is about $25 billion a day, and the NDF is about $40 billion a day. The numbers may be a little off, but broadly that's the scale. So it's grown by leaps and bounds, And for the longest time, it was, RBI's concern was that what would happen is, if you looked at today's closing, onshore closing, and tomorrow's opening, which was obviously driven by trading by offshore trading, very, very often there'd be a huge gap. And so companies in India would get screwed, right? So which is why they were very keen to try to get a handle on it. And again, like I said before, more power to them. I never thought they'd be able to, but what they've done very creatively, as I said, A, they intervene themselves. B, they've allowed it onshore. They've allowed onshore players to access that market in the expectation that, okay, if there's going to be a lot of trading, you will also get a chance to get those rates, right? So it's conceivable because of this. This has just started, right? It hasn't really got going in spades. It's conceivable that over time, this arbitrage will narrow and then disappear. I believe in the Chinese yuan, that is what has happened, right? So right now, there are opportunities, right? First and foremost, as I said, it's useful to try to get a sense. Again, if you follow the approach that I recommend, where you're hedging without looking at the market, you're hedging based on your business and your business forecasts, then it's not relevant. But sometimes your sudden remittance comes in, or you need there's a spot payment coming in, and you need to know whether to do spot pay or cash tomorrow. You could look at the offshore-onshore spread and perhaps get a little window on how to get a little bit better. The other thing that's curious and interesting is this permission to Indian banks in GIFT to access the offshore market. Well, it's useful to arbitrage on the NDF. When there is a big arbitrage, you can buy here and sell there and put the money in your pocket. Now, used to be you needed to have a subsidiary abroad to do it, but now you can do it onshore. Because RBI has also allowed significant volumes where you can buy or sell without having an underlying. So if you have an inclination to do that, talk to us, we can show you how to do it. But what may be more interesting is the offshore market is much, much more sophisticated. So there are lots of very interesting hedge products, right? I mean, there are like, let us say, they have these forwards with a knockout, where you can sell today up to 12 months forward at a rate better than today's forward rate. But if the market knockout gets hit, and the knockout looks to be very, very far away, then you're in the market. So if everything's reasonably calm, you'll make a lot of money. Things go to hell, you'll go to hell. Now, to my mind, while they're all very exciting and they're very well sold, and really I saw a transaction recently where the knockout was so high, I said, that's never going to happen. But some of you may remember back in 2006, 7, 8, there were all these complex products here where it's never going to happen. The Swiss franc is never going to fall to that level. It never has. Well, it did. So I would not recommend trying any of these products, but where you could get value from the offshore market is if you are looking at long-term, medium-term hedges. If you have exposures for a long period, there's more liquidity there. So I think that's really, more or less a little top up on the NDFs.
One more on the NDF.
Yeah.
Yeah, one more on the NDF market. I believe you have answered most of it. So there's kind of wanted to check, what kind of development, or how are the onshore companies and participants going to adopt to this, and how quickly are they going to try this? I believe you answered a bit of that while you were explaining.
Well, I know that a lot of the private banks are trying to get geared up. We actually almost, I don't think we got the contract from a private bank to help them train their team in these kinds of products and how to. So I mean, I think probably over the next 3-6 months, you'll have your bankers knocking on your door with these offers.
There's one more from a company into import. So if you can just answer this particular question. So as an importer company, what strategy should be opted when the dollar is weak in international market and we expect the rupee to appreciate, but all of a sudden the RBI starts buying and such things happen of market intervention. So can you please advise on that?
I sort of covered it in the talk. I'm saying that you will always be in situations like that, where the truth is you don't know what the hell is going to happen. It looks to you like if you don't hedge, you're in reasonably good shape because the rupee is looking strong. And then suddenly you could get hit. I mean, it didn't just look like it was going to happen. Like it hit at the opening. Now, we're all breathing easily. We don't know what Monday is going to bring. I mean, today is a Friday. So conceivably in the US, the Dow may take a further dump, in which case you'll probably see 76.30, 76.40 on Monday. So I'm saying, the only way to manage any risk is to do it with modest expectations and with a very definitive stop loss. If you just want to ride the market, that's fine, but keep a stop loss and respect. That's the biggest trick.
Okay. Yeah. There is one more, which obviously you have spoken throughout your talk. There's someone asking about the year-end expectation on the dollar rupee.
The what?
Year-end expectation on the dollar rupee rate.
9,022. I don't know. How can anybody know? In fact, I'll tell you, when I was writing an article, and I write articles from time to time, that chart I showed you about the, what has happened. So I said, well, okay, let's say the best thing happens and the worst thing happens, right? And I got a range of 69 to 90, right? So, not have any value at all. I don't know where it's going to go. And let me tell you, if anybody tells you where it's going to go, don't believe them, because they don't know either.
And one more, with the reserves now close to 500 billion, and as you have mentioned during your talk, RBI has been very keen to buy every now and then. Do you have any intuition that USD INR is going to stay closer to the current levels with the intervention?
The fact is that they are trying to prevent it from strengthening, right? But that original chart is actually very useful, because there are many times in the past where RBI has done the same thing. They didn't want the rupee to strengthen, but when the market gets too strong, it blows through. Now, it's hard for me to imagine that the market could fall so in love with the rupee that it could blow through the 74 level, and go to 73, 72, whatever. But again, the longer you live, the more you know that you don't know. So I don't expect the rupee to go to 70. I can't imagine it. But I'm not betting against it. I used to do a lot of gambling as a kid. I used to go to the race course. I made a lot of money and lost it all back. That's good, because I'm not doing it here.
Yeah. And to continue on the same point from the same person, it's also talking about the balance of payment surplus that we recently saw in a report, and which is kind of bound to happen in the current scenario. So that kind of inclines towards indicates a near-term appreciation in the rupee, right?
It certainly does. But like I said, clearly, even if you hadn't told me that, I would know that the guy asking the questions is an importer. But importers are looking for things that will make the rupee strong. Now, someone who's an exporter, you say, look at the mess Trump is making. It looks like Biden will come in, and there will be the economy, the politics will move left, economy will move left, and equities will collapse, right? And the rupee will go down with it. So, you can make both arguments.
And you spoke about the weak fundamentals for the country. So someone wants to know, if not India, then which other emerging markets? So where do you see the money moving out and not coming into India and to some other emerging market economy? What is your take on that?
See, I feel, I don't know, I feel at a time like this, it's all or nothing, right? All emerging market, when it's risk off, nobody goes to emerging markets, right? Because maybe, we don't want to take risk. I'm happy to earn 0.1% of the time, right? Having said that, there is one other point which goes against our friend who's importing, although it's not anywhere near certain. Moody's just brought us down to just above investment grade, right? So all the rating agencies have us just at the floor. Now, let's talk about domestic. If something terrible happens here, and my God, the situation is pretty bleak, right? And in terms of the virus, in terms of growth, in terms of a lot of things, right? ILFS's sister could be hanging around the corner, right? If anything dramatic happens in India domestically, and one of the agencies downgrades us, there will be such a rush for the door, because pension funds are not allowed to invest on this investment. So, that's another window that could suddenly pull the rupee to hell. I'm not saying it's going to happen. You know, we pray it doesn't. But I'm just saying there are so many forces. All right, we all done?
Okay. Any more questions? I have nothing more in the questions tab. So from any of our clients.
Any questions from you? We've talked a lot. What do you need to talk?
Yeah.
Okay, okay. Well, thank you all very much. I hope you enjoyed it.
Fine then.
Just let me just finish, Imran. And, sorry again for the technical difficulties, but we'll get better. In fact, I was thinking, because really nobody knows how long this lockdown is going to last. And for our business, actually, it's relatively easy to work out of the house. So we're thinking that conceivably we will do these maybe every month or every 3 weeks, because by God, in a month or 3 weeks, lots can happen to the market. And if nothing else, it's fun for me. So thank you very much.
Okay, thank you so much all for coming on this platform. So this is kind of a new thing for all of us, but we'll be doing this quite often from here on, because that's how it is we're going to be, and it is a very good way of staying in touch with our clients. Thank you so much for joining.
All right, bye. Good luck.
Have a great day. Bye-bye.
Yeah, bye.